Hello, I'm Julie Price, and welcome to Juniper's third quarter 2023 economic review. Thank you very much for joining me. The U.S. economy proved more resilient than many anticipated in the first half of 2023. Stronger than expected economic data and resilient corporate earnings have also supported markets and pushed expectations for a U.S. recession out to 2024. However, despite a rosier start to the year, the outlook for the economy going forward is still for slow growth, as the tightening in credit conditions will likely pose a greater headwind to economic activity in the quarters ahead. The consumer has held up remarkably so far, but the resumption of student loan payments and the depletion of savings may lead to more conservative consumer spending ahead. Meanwhile, the Fed has maintained a hawkish tone. At its May meeting, the Fed kept rates unchanged at 5% to 5.25% for the first time during this tightening cycle, but forward guidance suggests the potential for additional rate hikes this year. Regardless, the Fed does seem to be near the end of tightening, and growing drags on the U.S. economy should convince them to stay on the sidelines and potentially ease monetary policy next year by more than they are currently expecting. Even considering the twists and turns of this year, many sectors of the markets have posted solid gains year to date, and volatility has been relatively benign. However, considering last year's large market corrections, valuations are still at attractive levels compared to history. The questions for investors are when to take advantage of these better valuations and which areas to overweight or underweight in a very complicated macro environment. In particular, we assess the performance of this past year for the markets and economy, considering trends in jobs, growth, inflation, profits, the rest of the world, and the U.S. dollar. This is followed by comments on the outlook for monetary policy. Finally, we consider the implications of all this for those investing across asset classes and highlight the importance of taking a balanced view to asset allocation. Any investment strategy should start with a broad assessment of these fundamental issues. To help us out, we turn to JP Morgan's Guide to the Market. Join me while I discuss these topics and more. The U.S. economy remained resilient in the second quarter of 2023, and this has widened the runway for a potential soft landing. However, a quick look across each sector of the economy tells us that economic momentum is still slowing. Business spending appears to be one of the most at-risk areas of the economy. Recent layoffs in the tech sector could weigh on R&D spending, while increased caution among lenders and slowing corporate profits could constrain capital expenditures. Additionally, elevated vacancies in the office and retail sectors should weigh on construction spending, but this could be partially offset by rising demand in warehousing and data centers. The housing market appears to be stabilizing, albeit at low levels, as tight housing supply and steadying mortgage rates are signaling that the worst is behind us. Trade should be a mild drag on the economy due to the lagged impact of a strong dollar. However, the global economy has been gaining steam, and the trade-weighted dollar has now fallen by 10% from its peak last summer, which should limit the damage of deteriorating trade moving forward. Overall, the U.S. economy should continue to grow at a tempered pace from here, and while a recession is not guaranteed, a slower-moving economy will be increasingly sensitive to shocks. There remain risks on the horizon, most notably weakness in commercial real estate that could push this slow-moving economy into recession within the next year. Here is a slide that we've been monitoring for the past year. The National Bureau of Economic Research, or NBER, determines whether or not we are in a recession. In recent decades, the two measures that they have put the most weight on are real personal income less transfers and non-farm payroll employment. As you can see, real personal income was up in May, and non-farm payrolls are continuing to be steady. Industrial production was down in May and only down 0.1% over the last 6 months. The labor market has been a bright spot throughout this economic expansion, but cracks are beginning to emerge. Recent employment reports have shown the economy continues to add jobs at a robust pace, but the trend of job gains has been slowing over the past year. Improved labor force participation has so far supported job growth, with the participation rate for adults aged 25 to 54 having fully recovered to pre-pandemic levels. However, while the short-term impacts of the pandemic have now faded, aging demographics continue to place a structural limit on labor supply growth. The participation rate for adults aged 55 and over has remained depressed, reflecting an aging baby boomer population that has permanently left the workforce. Even with higher wages and low unemployment, the labor force participation rate may be at its peak. Other labor market data also suggest a trend of normalization, as shown by the wave of yellow on the heat map. Weekly initial claims for unemployment have been trending higher to average 240,000 in the second quarter compared to an annual average of 214,000 in 2022. While this increase is still indicative of a healthy labor market, claims may begin picking up more rapidly if layoff announcements become more widespread. Employees are also losing some confidence in their job prospects, as shown by recent declines in the Conference Board survey measure that asks individuals if jobs are plentiful versus hard to get. Business surveys are showing similar trends, with the PMI measures of services and manufacturing employment and small business hiring plans moderating in recent months. Tying this all together, cooling demand for labor suggests that job growth should decelerate in the coming months, and it may even turn negative, which would signal the economy is likely entering into a recession. A tight labor market has allowed the unemployment rate to hover around its 50-year low despite cooling demand, averaging 3.5% this year after an uptick to 3.6% in June. Importantly, cooling labor market conditions have contributed to a moderation in wages, which grew by 0.5% month over month in June for all private workers. Year-over-year wage growth has now come down to 4% from a peak of 5.9% from March of 2022. There is a limit to how much the unemployment rate could rise going forward, as businesses still face a structurally smaller labor force than prior decades. Diminished legal immigration, particularly over the course of the pandemic, and baby boomers reaching retirement age have left the economy short of workers. As businesses reel back hiring efforts in the face of slower demand and higher costs, we may see unemployment rise further by the end of the year, but only modestly. However, wage growth should continue to decelerate and help give the Federal Reserve confidence that inflation is sustainably coming down. At the end of last year, the global economy was losing steam, with only 27% of the countries shown here registering a manufacturing PMI above 50 in the fourth quarter of 2022, which is a level associated with accelerating economic momentum. At the time, energy troubles left Europe at a heightened risk of recession, and zero-COVID policies were dragging on activity in China. In 2023, the global economy has gained speed. Now all of the countries shown here have a manufacturing PMI above 50, while the global services PMI is at an 18-month high. Fortunately, the two risks in Europe and China have turned in the other direction. In Europe, energy prices fell after a mild winter allowed natural gas inventories to improve, and fiscal stimulus is further supporting Eurozone economy. In China, the lifting of zero-COVID policies has allowed for a rebound in consumption after 3 years of sheltered activities. Travel and leisure spending have bounced back strongly, but a rebound in other services and goods spending remains dependent on a recovery in private business and consumer confidence, which has so far been tepid. Still, China's recovery will act as a strong tailwind for its trading partners and tourist destinations across Europe and Asia. As such, divergent paths of growth across the global economy are beginning to emerge, with the U.S. slowing while Europe, China, and broader Asia accelerate. Despite economic headwinds, equity markets have had a solid 2023 so far, supported by a better-than-expected first-quarter earnings seasons and expectations for a forthcoming end to Fed tightening. S&P 500 operating earnings per share rose 6.4% from a year earlier and 4.3% from the fourth quarter. Profit margins also rose to 11.7%, indicating that companies have had success in defending margins. That said, risks to earnings remain to the downside. While the heightened risk of recession in the coming year, profit estimates should come under further pressure. Current commentary also suggests that firms plan on reining in investments, although cuts will not be evenly distributed. Investments in equipment tends to see the largest pullback in investment as the economy slows, suggesting we may see cuts within the manufacturing and mining sectors. However, investment in technology, specifically artificial intelligence, should continue to rise as companies seek to optimize processes for long-term cost savings. At the current juncture, it's difficult to be overly bullish on equities. While performance this year has been better, it has been entirely driven by valuation expansion on the back of lower interest rate expectations, with the top 10 companies in the S&P 500 accounting for 13.8% of the 14.9% price return year to date. Expectations for policy easing may also be too optimistic. As expectations adjust, multiples could come under further pressure. This, along with slowing growth weighing on earnings expectations, creates a challenging backdrop for equities ahead. Given this, we consider a defensive stance in equities with a focus on quality and cash flow generation. The S&P 500 index is up 16.9% for the first two quarters of 2023, a welcome surge since the market's October 2022 low. However, with higher prices, the P in the price-earnings ratio comes higher PE ratios. As of July 13th, we see that the S&P 500's ratio is 19.37 times earnings, nearly 3% higher than the 25-year average of 16.78%. As a reminder, the PE ratio is a valuation measure indicating that stocks may be over or undervalued when compared to its history. So are we in a bull market? The majority of Wall Street investors believe stocks have entered into a new bull market. The chart on the right tracks the length of historical bull and bear markets. The last bull market that started with the pandemic in March of 2020 lasted 21 months. The bear market that followed, starting January of 2022, lasted 9 months. But what would it take to return to January 2022's peak? The chart on the left shows that we need the market to return almost 8% over the next 12 months, or 4.7% each year for 2 years, or 3.6% each year over the next 36 months, and so on. Hopefully we can skirt recession and achieve a return to peak levels. Since the beginning of 2022, the Federal Reserve has hiked rates by a cumulative 500 basis points in an attempt to combat persistent and high inflation. At their June meeting, the Fed voted to leave the federal funds rate unchanged at a target rate of 5% to 5.25% for the first time since tightening began. While this move was expected, forward guidance is decidedly hawkish. The Fed's updated dot plot suggests that the pause in June may just be a skip. The median Fed member now expects a year-end federal funds rate of 5.6%, implying 2 more rate hikes this year with no cuts until 2024. The committee also increased their forecast for rates in 2024 and 2025, reflecting the committee's concern that elevated inflation may warrant highly restrictive monetary policy for longer. This more hawkish outlook also stems from the Fed's expectations of a more resilient U.S. economy. Compared to the March summary of economic projections, the median expectation for real GDP and core PCE inflation increased materially, while the median forecast for the unemployment rate fell to 4.1% from 4.5%. The committee does acknowledge inflation is trending in the right direction, but emphasized that they need further evidence that inflation is under control before calling an end to tightening. In light of the Fed's continued hawkishness, market expectations have become more in line with Fed guidance. Following the May Fed meeting, futures markets were pricing in 3 cuts and a year-end rate near 4.25%, whereas now there are no more cuts priced in for this year, and year-end rate expectations have risen above 5%. The trade-weighted dollar has weakened by roughly 10% since it reached a 20-year high last September. Although the dollar stabilized during the second quarter, economic forces point to further declines ahead. Specifically, narrowing interest rate differentials and widening growth rate differentials should continue to weigh on the dollar. After the Fed's aggressive tightening campaign caused interest rate differentials to widen in 2022, the Fed paused or skipped in June, and continued global tightening efforts have led to a narrowing in differentials. Additionally, better than expected growth in China and Europe and slowing growth in the U.S. suggest further downward pressure on the dollar as global growth outpaces the U.S. However, long-term fundamentals still pose headwinds. While the dollar has fallen from its peak, it is still trading near 20-year highs and remains expensive versus fair value. The U.S. trade deficit now amounts to 3.2% of GDP. This partly reflects the negative impact of the dollar on the competitiveness of U.S. manufacturing and should help push the dollar down going forward as U.S. demand for overseas goods, services, and assets increases the demand for other currencies. Over the long run, economic forces are expected to gradually drive the dollar down. In the near term, narrowing growth and interest rate differentials should prevent any sustained periods of appreciation. However, the dollar remains a safe haven asset and could still see bouts of strong performance during periods of uncertainty. Consumer sentiment has since staged a modest recovery since hitting a new trough in June of last year. However, banking sector turmoil, fears of a U.S. default, and the growing weight of the Fed's aggressive tightening campaign kept consumer sentiment depressed in the second quarter. Looking ahead, increased risk of recession and weakening in the labor market could keep consumer sentiment depressed this year. This slide shows the University of Michigan Index of Consumer Sentiment stretching back over the past 50 years with 9 distinct peaks and troughs noted. Also shown is how much the S&P 500 went up or down in the 12 months following the peaks or troughs. On average, buying at a confidence peak yielded a return of 3.5%, while buying at a trough returned 25%. This is not to argue that U.S. stocks will return anything like a 25% return in the year ahead, as many other factors will determine that outcome. However, it does suggest that in planning for the remainder of 2023 and beyond, investors should focus on what they own and valuations rather than when to buy and sell and how they feel about the world. Looking at consumer saving and borrowing, this slide tracks the personal savings rate since 1960 on the left. The savings rate spiked in 2020 and 2021 due to fiscal stimuli. As inflation followed, the rate dropped in 2022 as consumer spending increased. Year to date, we are still far below the 63-year average of 8.9%, sitting at only 4.3%. 60% of Americans live paycheck to paycheck, yet they're continuing to spend like they are still receiving stimulus checks. Revolving consumer credit has also been increasing despite the increase in interest rates. However, consumer credit has not quite reached pre-pandemic levels. This decreased savings, along with forthcoming resumption of student loan payments in September, should weigh on consumer spending in the coming months. In the wake of last year's broad market sell-off, lower valuations presented investors with a new slate of opportunities across asset classes. While markets have recovered from their lows, current valuations still look more attractive compared to lofty levels at the end of 2021. Shown here are 10 of the major asset classes and styles and their valuations expressed as Z-scores versus their respective 25-year history. A z-score is a measure of risk. Negative z-scores indicate the value lies below the average. Positive z-scores indicate the value lies above the average. This allows us to illustrate how normal or abnormal current valuations are. As you can see, asset classes across the board are much cheaper today compared to the end of 2021, but by varying degrees. Fixed income continues to look attractive as U.S. Treasuries, core bonds, and municipal bonds remain below their average valuation levels. International equities continue to trade at a historic discount, while some areas of the U.S. market, specifically large cap and growth, still look expensive after strong performances in the second quarter. When positioning portfolios for the remainder of 2023 and beyond, it is important to assess both the remaining risks on the horizon as well as the menu of opportunities presented in the aftermath of last year's market corrections. Within equities, investors may want to lean into international markets and focus on finding the attractively valued companies within the U.S. style spectrum. Also, the current opportunity presented in fixed income could pass rather quickly once the Fed begins lowering rates, and investors would be well served to take advantage of current yields. And to wrap up this quarter's review, we look at the matrix as of June 30th year to date. U.S. large cap equities led the field with a 16.9% return, followed by developed market equities. Almost all of the asset classes posted positive returns with the exception of commodities, 2022's leader. A broadly diversified portfolio like the 60% equity, 40% fixed income mix in white diversifies the asset class risk for a smoother result, returning 7.8% year-to-date June 30th. Thank you very much for making it all the way through this quarter's review. As always, please feel free to reach out to me to review this and more.